So here we are, part 3 of this options trading series, but this time we are moving to hard mode. Today we're going to explore a trade sequence on FTNT, ticker FTNT, that unfolded in the second half of 2023 and that pushed the options dragnet framework to the brink by triggering a recovery trade first and a stop loss second. Let's get into it. So quickly before we start, I want to emphasize why this episode in our options trading mini-series is the most important one. If you've been looking for trading strategies for long enough, you know that every single time, the only examples shown to you are cherry-picked to only display the winners. However, success in trading is not achieved by taking profit, but rather by managing risk. That is why wrapping your mind around the real-life worst-case scenario that follows is so crucial. So this trade sequence on FTNT stretched from August the 16th, 2023 all the way to the close of November 10th of the same year, basically during the large correction that plagued Q3 of 2023. The initial put writing occurred shortly after an earnings release crash that sent FTNT from $75 down to $56 overnight. On August the 16th, the framework detected that all criteria were met for a trade, which resulted in the sale of an aggressive and very short-term in-the-money put option with a strike of $60 and an expiry of August the 25th. It was sold at a premium of $1.95, while FTNT was trading in the vicinity of $58.50. Obviously, with such a tight maturity, at this point, the quasi-entirety of the put price is made of its intrinsic value. The stock failed to recover above $60 before the expiry, which was fine and expected with such an aggressive trade, and the shares were assigned at $60, leaving us with an outright position in the stock. However, at the close of August the 25th, which was $58.81, the risk-based kill switch of the framework was not met, and we were good to immediately roll the position over to the next month, but this time with a recovery trade in the form of a covered call option. The volatility analysis of the stock prompted me to choose a strike of $60 again and a relatively short maturity of October the 6th, the combination of which yielded a premium of $1.90 per share that satisfied the minimum yield criteria of the framework. At this stage, we had $3.85 per share collected in premium so far. Now fast forward to October the 6th, and the stock unfortunately closed a whisker away from the $60 strike at $59.93. So once again, volatility analysis and minimum yield requirements were met for a short-term 1-month covered call option with the same strike of $60 and a maturity of November the 10th. We collected another $3.14 in premium, making our cumulative total $6.99 per share. A new earnings release came at the close of November the 2nd, but the criteria for an early exit that we reviewed in the previous episode was not met before then. Unfortunately, it turns out that the earnings got reported way below consensus, which sent the stock crashing for the second time in the second semester, and this time by minus 22.8% from previous close to next open, luckily though, as you can see, with quite a significant recovery on the same day. Now, before we move on to analyzing the decision-making process going into the call option expiry day, I want to take a second here to comment about why we would see such an intraday recovery after the terrible earnings release. The main reason why such an immediate rebound was possible is statistical. You see, the more stretched the move against long-term drift, the faster and more intense the snapback. By using the framework's volatility analysis model, we knew that $60 was already a very oversold level, not just short-term, but also historically. So every additional downside was getting immensely overdone and was exposing shorts to a massive squeeze. That is why the way the model is screening volatility ahead of time is so important, because by the time a position is initiated, it takes away a major portion of the risk out of the trade by making sure that the risk has, once again, been discounted both contextually and historically. Hence why any further downside should be very limited in both scope and duration, and that is precisely what we observed here. So anyway, back to our trade. FTNT ended up closing on November 10th at a price of $50.82, printing an unrealized loss of $9.18 per share. Remember, up until that point, we collected $6.99 in premium in total. Comparing the collected premium to the floating loss is how the options dragnet framework determines whether we should take a loss and walk away. In this example, that was the case. And so we sold FTNT at the close of $50.82, realizing a loss of $9.18 per share, buffered of course by the $6.99 in premium collected so far. That is a net loss of $2.19 per share, or 3.65% over the $60 per share notional of our position. Not too bad a loss actually, given the the fact that we faced an absolute worst case scenario during this trade, with the stock crashing after the quarterly earnings release. Now let's take a step back together and merge the easy, intermediate, and hard modes that we reviewed so far. This is the decision tree that summarizes the steps taken to manage these trades and that you should keep in mind. As you can see, the branches get more complex as more risk needs to be managed. Whatever the case may be, however, the framework covers every single possible scenario in order to protect capital as efficiently as possible, while leaving as much room as the market offers to generate income. Now feel free to pause here and take a longer look at the decision tree, and note that all proprietary techniques are 100% revealed in the framework. That'll do it for this episode. In the next one, we will recap everything about the model in a condensed video, and I will answer the most frequently asked questions for you. Up until then, feel free to ask anything that you believe remains unclear in the comment section below, and I will do my best to answer you. I'll catch you in the next one.